Hey, this is Matt from InvestiQuant. Today is Tuesday, January 11, 2022. Yesterday, the markets put in a reversal pattern. We gapped it down and took off to the downside early on, but in the afternoon, the buyer stepped in aggressively and reversed it back up. We took out the open. We closed up at the highs of the day. However, we did still close at a 10-day low here in the S&P 500, but we've got a giant hammer-like candlestick that has formed, and the overnight session is balancing a little bit higher in the overnight session. So what we'll look at this morning is what has happened historically with this type of reversal-like pattern. Let me go ahead and grab all four instruments. The setup will be based upon entering the market long at 9:30 a.m. Eastern Time and exiting at 4:15 p.m. Eastern Time. Now, currently, we are trading higher in the overnight session. It's a quiet range, but it is higher. We're actually above yesterday's high, but I'm going to leave that out for right now just because I want to keep as many samples as possible. I'm going to click on Gap Up, which means that the opening print needs to be above the prior day closing price. And then in the price patterns library, I'm going to say that yesterday closed at a 10-day low, so I can do that by going to the active today and then going down to the new low section day after a 10-day low close. But then I'm also going to add a little bit more context around where the actual closing level was, and it was up near the highs of the day. So I'm going to go to the location last close here and click on close in top 25% of the daily range. I could go with the top 10%, but that's going to get rid of some samples. I want to keep a few more in there and still capture the idea. So this means you closed up near the highs of the day, but you were at a 10-day low. And with this type of pattern closing up near the highs of the day, that's going to show a lot of range below the closing price, which can be like a wick like we saw yesterday down at the lows. All right, next I'm going to go into the indicators library, put us above a 200-day simple moving average. I don't need to add the 10 because I've got day after a 10-day low close. Now I can click view results. All right, here we go. These are the results based upon entering the market long at 9:30 a.m. Eastern Time, exiting at 4:15 p.m. Eastern Time. When you gap up after a day that was a 10-day low close that closed near the highs of the session, this is taking place above a 200-day simple moving average. This pattern is very rare. We've only got 11 samples here in the S&P to look at dating back to 2003, so not much to look at, but it's happened 11 times in the S&P. It's happened 11 times in the NASDAQ. There's 15 samples in the Dow and only 3 in the Russell, so almost nothing there to look at in the Russell. If we look at the win rates on them, the ones that do have a handful of samples each, the S&P, NASDAQ, and Dow, the win rates are all coming in a little bit favored. S&P coming in at 64%, the NASDAQ 82%, the Dow 60%, and then the Russell, which only has 3 samples, is 33%. If we look at the average moves, the average winning trade on this is larger than the average loss for the S&P. That's also the case for the NASDAQ and for the Dow. The Russell is pretty similar in size, but the Russell just doesn't have much to look at here. So looking at this pattern, which does not happen often, we've got 3 instruments where we've got a handful of samples each on it, and those 3 have all leaned a little bit more towards the long side following this reversal-like pattern. Hopefully you found that helpful. Good luck today. We'll see you next time.